Welcome back. Well, IDFC First Bank is the next one on our radar right now. Now, we actually have with us, I think, Mr. V. Vaidyanathan, MD and CEO of the bank, joining in. Stocks under pressure, about 5%. Mr. Vaidyanathan, great to have you on. You already know the concerns, right? And it's not just with IDFC First. I think system-wide, the issue is on asset quality stress in the MFI segment and wherever there is unsecured lending. So I just want to start with MFI first, and then we'll talk about the retail book, which I know has done better. You've increased your credit cost guidance from 2.25 to 1.65 earlier. So how deep and how prolonged can the pain be? What exactly are you witnessing in the MFI space right now?
First of all, that 1.65 was excluding JLG. So including JLG, it was 1.85. Now we're seeing 2.15, 2.2, the number you said. Now the key thing actually is that in the MFI segment there is real stress. We can see it in the market and we can see it in the collection percentages, and we can also see it in the SMA. SMA is the bucket pre-NPA. Our number in the last 2 quarters have increased from 1.6% to like 2.5%. So we wanted to recognize it, and we have therefore provided at 30 days past due itself. Normally provisions start at 90 days past due, and in that also we were providing 75% at 90 days past due and 100% at 120. We have preponed the whole thing and we have taken at 30 days past due, and that is the reason why you see a provision increase on the microfinance business.
Okay. Good morning, Mr. Vaidyanathan. Once again, thank you very much for joining us. As you pointed out, the SMA book, the number has increased. So can we assume that there will be, third quarter will also show higher slippages than second quarter?
We should be very careful, Latha, with this. It's only the MFI business that has gone up. So let's focus on MFI in this conversation for now, because that is the key point of this quarter. So we will talk about the rest of the book, and we will definitely address that. Now, on the SMA front, yes, it has gone up to 2.5. But since we already provided at 30 days past due itself, Latha, the next quarter credit cost because of MFI will not be this much. It will come down.
Okay. And it'll come down. I take your point. I take your point, but you are assuming that there will be higher slippages. That's why you're provided. So the slippages can rise. When do you see it plateauing off?
Yes.
Will it plateau by the fourth quarter, or will it take even longer?
Yes, looks like there are various estimates in the market. It's an industry thing, but yeah, certainly Q4-ish looks like it'll peak off, and our analysis also shows that Q4 it'll peak off, and then subsequently next 4 quarters it'll. These are only 2-year loans, Latha, so they all have a peak and they go away. Obviously. But incrementally, I wanted to share with you that we are insuring a book with CGFMU. We saw this problem, frankly, way back in December of 23. Our data told us. So we started insuring our book with CGFMU. So already, every booking since January of this year is fully insured. Fully insured means insured basis. So therefore, it's now touched 50% of it.
So Mr. Vaidyanathan, I think that's the first part of the conversation. That's a clear headline that you're guiding for MFI stress to peak off by Q4, right? Now let's talk about...
That's our estimate, yeah.
That's your base case. Got that. So now let's talk about the other segments of the book. Tell us trends that you're witnessing on both credit cards and personal loans. What's happening there?
That number also we have put out this time publicly. You must see a page number 32 of our investor presentation, where we have given segment by segment SMA, and the subsequent page we have given segment by segment, product by product NPA. So our whole book is like everything is clear out there. So in the SMA segment, for other than MFI, which went up sharply like this, every other segment, our SMA is very, very good. It's very stable. It's out there in page 32 of the presentation.
Saw that. I also saw that, whereas your overall GNPA is 1.92, the personal loan, the consumer loan NPA is 2.08. You have gone to that extent of transparency, and thank you for that. But therefore, the question, since you're acknowledging that the GNPA in personal loan is more than the overall GNPA, should we expect slippages over there?
Well, it's marginal, 1.9 and 2.08. But let me specifically take the unsecured book so that it's an important one. We'll put it behind us. The unsecured book of the bank is 15%. Unsecured retail book is 15% of the book.
Okay.
Now, on that book, plus we also have education loan, where it's end use is defined, but that's also unsecured in that sense. We also have consumer durable book, which is end use defined, but we should treat it as unsecured practically, because you really can't repossess a washing machine or something. So if you take all of this family together, all unsecured put together, this is all put together is, you'll find that our NPA is 2.08%, net NPA is 0.5%. So we are watching this very, very carefully, and we are one big beneficiaries of tightening credit policy 12 months before today. Today, if we are smelling good on the rest of the portfolio, is because the work we did maybe 12 months ago that we are smiling on the portfolio, excluding MFI. MFI is an issue. Talked about it.
But Mr. Vaidyanathan, to just press on that point, for the unsecured book in its entirety, which you're saying you're watching very carefully, is the base case that you're expecting some more stress to build up? Are you expecting gross NPAs and net NPAs and slippages to start rising in this book as well over the next 2 quarters?
We mentioned the NPA to you. It's 2.08 and 0.5 unsecured book, 15% of the book. We described that. Now, away from that, see, we'll have to watch it very carefully. But you see, we have never done the subprime kind of personal loans. It is not that. So that is more like a fintech's game, that they give a loan on the fly immediately for 20,000 rupees, 50,000 rupees. We don't do all that kind of stuff. So we expect this to be stable, because end of the day, remember, the stress is in the MFI segment because too many lenders went there. But in the general segment, the salaried employees, Infosys employee, Wipro employee, Unilever employee, they're all fine.
No, I take your point. 2.08 for your consumer loan segment is not sounding alarming at all. And it's very helpful that you have given that separately. Let me now come to the margins part. It's not reduced much, just 4 basis points quarter on quarter. But have cost of funds peaked, or do you think it can still, shave away from your margins? The margin guidance for second half?
No. First of all, our cost of funds, we don't expect it to increase from here on. Even last quarter, we did not increase the cost of funds. Just to be precise, our cost of funds is 6.38%. Cost of deposits and the cost of funds because of legacy money is 6.46 or so. So that we don't expect it to increase from here because we are getting deposits in abundance. I think in this talk we missed the point about how deposits are growing. For our bank, Latha, let me point out, deposits growing at 32% on a base that is now touching 218,000 crores. I believe that our ability to raise deposits like this at low cost is a big strategic advantage of the bank. In the milieu of this credit cost of MFI, we may miss that story. So I'm just pointing that out.
No, absolutely. I mean, your CASA ratio is almost at 50%, and we haven't missed that, Mr. Vaidyanathan. We've taken that on board. Colleague Abhishek is also here. Some questions, Abhishek?
Yeah. Mr. Vaidyanathan, if you could, highlight with respect to how much is your CGFMU coverage. What I understand from analysts is that it's around 50%. If I compare that to peers, it's slightly on the lower side. Could you just highlight on that front, please?
We started stress in MFI. We started seeing stress in MFI sector in December of 23. So every loan book from January onwards is insured by CGFMU. Since new bookings are insured, we have now reached, and past book runs off, we have not touched 50%. By end of this year, we'll touch 75%. And by end of or middle of next year or maybe middle of next year, we will touch 100%. So, but the thing about CGFMU is that there is a 1 year window in which there is a hiatus period after which they settle. So the benefit of our CGFMU insurance on our portfolio will be seen by us in FY27. That is 26-27. And but in the meanwhile, we have tightened a lot of controls on MFI credit.
Okay, all right, Mr. Vaidyanathan, we'll leave it on.
No, wait, I'd just like to say one quick point. That this, one of the reasons we've also taken for this, why we've taken advanced provision on the microfinance business, since we are at it, is also that we want our employees not to put any stress. I'm using your medium to communicate all our employees in one go, that don't put any stress on our customers at this point of time. They have their own challenges. So we have taken it up front. Now we're not under pressure. Now,
Got it.
take it smoothly, give them some time, and smoothly take out our money. They'll be happy, and we should be sensitive. And secondly, I must say that the MFI sector is being talked so much in industry, but it meets 3 magic boxes, tick marks. That's
Got it.
women's entrepreneur, micro. It's an important segment for India. We should live and learn, but it's an important segment.
Point taken, sir. It's just that, it's a listing time. That's why we have to wind up. We will invite you again for a more detailed chat. Thank you very much for joining us, Mr. Vaidyanathan.